Hello, I'm David Chaston with 90 at 9, brought to you by interest.co.nz. This week, get everything you need to know in 90 seconds at 9 o'clock. With news, the world's biggest economies are facing enormous challenges. First, in the US, the size and implications of their fast-growing debt problem is revealed in today's Treasury announcement that they will auction $211 billion in securities next week alone, comprising $127 billion in new debt and $84 billion in rollover debt. Yes, that's right. $1/5 of $1 trillion in 1 week. Across the border, Canada added 28,800 new jobs in September, double the gains reported for August, but almost all were in trucking and delivery jobs, as well as education and healthcare. Factory jobs decreased, a sharp reversal from August. And the Shanghai equity markets were down 3% yesterday, in a sharp contrast to most other markets. Shanghai is now down 12% since the beginning of October, down 23% since late May, and down a massive 43% since the start of the year, which was its recent high. By any definition, this is a full bear market in China and dangerous territory for them. Margin calls and write-downs will be causing real issues, unreported because of their censorship laws. Clearly, the home team has proven useless to stem the red ink. This drop has unnerved Wall Street, which is also down sharply today, down almost 1.5% in mid-afternoon trading. Japan's trade balance has bounced back to a surplus for the first time in 3 months of about $1.2 billion in September. Exports were down 1.2% from a year earlier, the first contraction in 22 months. Demand for cars and mobile phone parts was sluggish, restrained by typhoons and earthquakes. Imports were up 7% due to higher crude oil prices. Back in China, their central and local government fiscal revenues, that's taxes, grew just 2% year-on-year in September. This drop in the growth of tax collections is a surprising result and may reflect a sharp slowing in commercial activity in the country. In Australia, consumers are facing higher prices for staples such as bread, chicken and cheese, as drought-driven crop shortages, rising fuel prices and the weaker Aussie dollar pushes up production costs. And economists at AMP Capital have raised their estimate for the housing market peak-to-trough decline to be minus 20% in Sydney and Melbourne over the next 2 years. Low auction clearance rates, tighter credit availability, and change policy around negative gearing from a win by the Labor Party in the next election has seen this decline deepen from their previous estimate of minus 15% drop to now 20% drop. If they are right, all the gains of the past 3 years will be erased. The US Treasury yield is still at 3.17%. Gold is little changed at $1,226 an ounce. US oil prices are down again today by another $1 a barrel to just over $68.50 a barrel, and as the full implications of the building US crude stocks sinks in. The Brent benchmark is now down to $79.50 a barrel. And the Kiwi dollar has slipped today and now at 65.4 US cents. On the cross rates, we're at 92.1 Aussie cents and 57.1 euro cents. That puts the TWI at 69.7. And the Chinese yuan is also approaching 7 to the US dollar, almost matching its lowest level since 2017 and getting nearer to its rate in 2008. I'm David Chaston. That was 90 at 9, brought to you by interest.co.nz.